Okay, so as discussed tonight, I'm going to walk you through the case study to prepare for the final. This is our case study here to the right, and we're going to talk about a movie called Journey to Bali. It's a mainstream action feature, and we're going to release it in the US through a rent-a-studio deal with Paramount, which, as you remember, is a deal where we basically work with the studio and hire them to create the marketing campaign and book the theaters. So it is a service we pay for. And the way we pay for this service is by engaging a P&A investor who pays for all the P&A release campaign related costs, such as marketing, any materials, advertising, anything that is related to creating awareness about the film and its release in 1,500 screens across the US. And we're going to have Paramount Studios do that work for us and book the theaters for us. So we're basically renting the studio. And because we're doing that, the studio is not giving us a minimum guarantee because it's not really buying the US license rights. It's just giving us the opportunity to use its relationships with the theater's owners to release the film in the US on our behalf. That's what we're doing here. The international rights will be estimated a little higher. In this case, it's at 80% of the budget as a low estimate, because of the fact that we are releasing the film in 1,500 screens in the US, which elevates the value internationally. So the international distribution rights are often higher, and the revenues are higher for any movie that is theatrically released in the US in a wider fashion. So wide release means anything over 1,000 screens is considered in the international market by many distributors a wide release. So therefore they pay a little more as a minimum guarantee. So in this case, our assumption is 80% of the budget for international distribution rights revenues. Sales agent is going to charge us 15% of a sales fee plus 1% for distribution expenses, and it's going to defer everything with the exception of pre-sales, for which it will charge only 6% altogether. So a reduced sales fee just for the pre-sale component, and then the balance is going to be due on recoupment. We are bonding the film, and the insurance fee is 2% of the applicable bonded budget. Applicable means we are not paying for the contingency amount, because the contingency is a safety cushion. It's an amount that we have available in case we go over in certain areas. So this amount may or may not be spent. And we're asking the completion bond company not to charge us for something that we may or may not actually spend. We also ask the completion bond to allow us certain exclusions. And in this case, we're asking for the exclusion for fees related to rights, the writer, the development, and producer and staff, and legal fees. The fee would therefore be only calculated on the applicable cost, meaning all the budgeted line items minus the exclusions. And this is what this is going to look like here. So when we take all our budgeted elements, which are here, we're putting our budget together first. That's our step one. We're taking all the amounts and putting them into our budget. So you have a budget template that you can use for this assignment. And you can actually also use it for the final if you like. You don't have to, but you can. Always check the formulas, make sure they work with the actual case study that's being given to you, because you want to make sure that everything makes sense. And not every Excel is automatically formulated in correspondence with the actual case study that you're working on. So please make sure that the formulas all make sense for the assumptions that you will be working with. So in this case, we start pretty simple. We're putting rights 25,000 here. We have the writing at 150, development cost 75,000, producer and staff is 850. Director and staff is 250. Our talent is 3.5 million. So all the above the line together is 4,850,000 on this limited top sheet. This is not a full top sheet, it's just a limited top sheet where I put a few columns together to make it a little shorter for you. I have a production and staff for, now we're going to talk about the below the line for 500,000. The camera department is charging 250,000. Set construction is about 25,000. Location costs of $50,000, and other allowances for below the line are just summarized at 6,200,000. So below the line for the shooting period, it's 7,025,000. Okay. Now we're going into the post-production. For all the editing, we're assuming $320,000. Film post, which is sound and color correction, $260,000. Visual effects, 320. For the music, we're calculating 120,000. And then we have some other post-production allowances that we're going to put in here for 650,000, which makes our post-production budget around 1.67. We have some general expenses and legal fees that we're accounting for here at 250, and we have some financing costs, which are 1,354,500. And the financing costs are described here. Let's go down. Legal, that's $250,000, and the financing costs are 10% of the sum of the above the line and the below the line. So the above the line and the below the line together, 10% of that is going to cost, it's our finance fees of 1,254,500. And in many cases, you have to budget these finance fees because you will be potentially charged certain finance fees depending on what investors you're working with. So you should always kind of budget about 10% in finance fees for the combination of above the line and below the line in general. So now we have our combined cost here of 1,604,500. We have the above the line, we have the below the line, we have some contingency, and then we have the bond company fee. And as you see, when you click on the bond company fee, you see that the bond company is charging its 2% on all the expenses minus these ones. These are the ones I'm deducting to make sure I'm not, in here also contingency, to make sure I'm not being charged an insurance fee on that. So here's our budget, 16,057,105. So that's the first thing we need to start with. And now we're going into the recoupment schedule. So here's the budget. Strike price is not quite there yet because we are still working on that. So ignore that for now, because the strike price is actually going to make us take our budget, and then we are reducing from that budget our in-kind services of $440,000. So why don't we do that real quick so we know we do this right. So here we go and take our budget, and then we are deducting from our budget our in-kind services, which are, let me just look where they are. Sorry about that. Going down here. They're going to be here later. So we're going to put that together, but we already know what it is. It's going to be, I'm going to go to put that in here. We have our visual effects and music. This is our in-kind services in this assumption, and I'm going to put them in here real quick so we're not forgetting about that. So visual effects, I'm going to go here and I'm going to find my visual effects comment, click there, and now it's there. In music, I'm going to find my music budget. Where do I have it? Here, there we go, and now it's there. But I'm going to take you from the top. Just wanted to make sure that we have the right number. So here's our sales estimates. It's 80% of 16,075,105, which is our budget. So far we're clear. So now let's go through all the sales that we have made. Let's go down here. When we talk about the funding, we're figuring out, this is our P&A investment, which we'll get to in a minute. But let's look at our foreign pre-sales. We have Germany for 10% of the budget, which is 10%, see, 10% of the budget, and 20% of this is our down payment. Italy, 7% of the budget, 15% is our down payment. UK is 8% of the budget, see? And 20% again here of that amount, of that minimum guarantee amount, is the down payment. And France paid us 9% of the budget as the minimum guarantee license fee for the French territory, and 20% of that license fee is our down payment. Now these territories, Germany, Italy, UK, and France, are called Tier 1 territory. And Tier 1 means these are very strong buyers, these are strong distributors, and the bank look at them in a way and saying, I will give you a large loan amount for these contracts because these are very reliable distributors and therefore they offer a lot of security for me. So the bank will look at this Tier 1 total later and give us a higher amount as a loan. Just keep that in mind. Here it's simply deducted, it's simply summarized. All our minimum guarantee distribution payments are summed up here. This is summarizing all our down payments. So let's look at our Tier 2 territories. And you remember the Tier 2 territories are the territories that are either economically weaker or they have a spotty payment track record with our bank. So in this case, we have India as a Tier 2 territory and we have China as a Tier 2 territory. And we're summing it up down here. This is our total distribution revenue from China pre-sales, and this is the down payment that we're receiving from China. There we go, we're summing it up. And altogether, our down payment is now 1,051,000. Let me make sure that's correct. Make sure that's correct here. And then our sales agency fee on the down payment that is due was 5 + 1, which is 6%. So we're only paying 6% on this down payment. So we have available 988, I'm going to mark this green, $988,000 as the first financing option towards paying our strike price. Okay, so we keep all this in mind, the Tier 1 territories and the Tier 2 territories, when it comes time to deal with our bank. So what our bank says here, as you see, and they're allowing us, they're giving us 93% of all our Tier 1 distribution revenues. And when we look at what we had in Tier 1, let's go back up here again. I'm actually going to click on this, and then you'll see where it comes from. 93% of our Tier 1 total, which was 5,459,415.70, and 93% of that is 5,077,256.60. Now Tier 2, these are territories that are economically weaker in the eyes of the bank. So 60% of the Tier 2 total is given to us as a loan, which comes to 96,342 in this case. So if I look down and I see what is my pre-sale loan as a subtotal, it's 5,173,599. And then I have to obviously deduct money that I already received, which is this amount. We need to do the gross amount, not the net amount. We have to consider the gross amount. So it's 1,051,740 that we are deducting. So the gross pre-sale loan here is 4,100,000. Hold on a second. I'm going to go down and make sure this is correct. 858,085 cents. So now for this part of the loan, which is the asset-backed loan, it's a loan against our pre-sale contracts, our distribution contracts. We have to pay 8% as an interest for the entire term. And that interest is charged against this loan amount. So it ends up being a net loan for us of 3,792,110. I'm going to make this slightly green so we know we're going to get this money. And then the next one, we're figuring out what are our unsold rights. And you remember that unsold rights The definition for that is you take all your sales estimates and you deduct your pre-sales because that's what you have now sold. And then you have the rights left that you can still sell pre-sales. There we go. So that's what that is. That's your definition. Yeah, sales estimates, money, Jeanette, minus all your pre-sales. That's how you figure out how many rights you still have available to sell when your movie is finished. I'm going to just mark this up as a little reminder. So what we want to do, we want to make sure that whatever we have left, which basically is, you know, we have our entire sales estimates, we're deducting our pre-sales, that should get us somewhere around 7 million here, 225,697.25. So now we're thinking how much of that is going to be applicable for the bank collateral. I'm going to write that down here, collateral, because the bank will only give us 50% of this as a loan. So that would be 3,612,848. Now, remember that only 20% of your budget are allowed as the cap, as the maximum you can get for your bank loan as the cap for the gap loan. So in this case, our 20% cap is lower than our collateral. So we have to apply that here. So we will not be getting the full 3,612,848. Instead, we're only getting the 20% gap cap amount of 3,211,421, and that is 20%. If you look at it, 20% of our budget. Okay, so this is why we are using this as our number for our gross gap loan. The interest for the unsold territories is higher because this is an unsecured loan. This is a loan against rights we have not sold yet, while this is a loan against rights we already have sold. So that's why this amount is going to require a larger interest for the term. So we're deducting 12% interest of the gross gap loan, and we will be left with a net gap loan of 2,000,000. We're going to make it nice and light and green, 800. So if I look together, I have a net bank gross loan. This is the portion I have to later pay back because I have to pay back all my fees. And this is my net bank loan, which is basically these two numbers combined. This is my net gap loan. Now, in this case, we do have some loan fees. I'm going to look that up for you. We have a loan fee of $65,000. So let's put that in here. And I believe we have a legal fee of $25,000. So let's put that in here too. So this will also be deducted from the loan amount, which then leaves us with a net loan, net bank loan that's available at closing. I'm going to write that down, net bank loan, so you know what this is, of 6,528,160.63. So I'm going to mark this so we know this is money that we have available. So there we go. Available for funding. Well, it's a different grade. Let's take this grade. So this is now. So now we have 988,635 from our pre-sale, from the down payment that we have received, minus down payment, minus sales agency fee. Is this? This is what we have raised first. And now the second part is we're getting a bank loan of 6,528,160.63 for the banking of our distribution rights and for an advance for rights we still have to sell. So that's where we are. So let's see where we are with our mezzanine. The mezzanine lender says here it's 15% of the actual production cost. The actual production cost is the strike price because that's the actual price, actual cost we're spending. So I have to go here and take this as my number. So it would have to be the actual production cost so that we know what we're spending, and the equity, the mezzanine vendor says, I'm only giving you 15% of what you're actually spending. So let's go down here a little more. And the interest was dictated to be 5%. So what we're getting then in the end, I'm going to make this back, is 2,225,437.46. So I'm going to make this again green. This is money that we will be having available for our movie, and that's why we put it here in our balance, so we know how much money we have raised. The next thing we are told, we're getting a 5% of the budget, what is it here, crowdfunding amount. So we're going to do that. It's 5%. There we go. Of our budget. There you go. There's the budget. It's 5%. So there we go. And we're paying 25% in fees. And I'm looking here, is there any development fee that we have already used? Yes, we have used already 20,000 of it. So that means we have to deduct it here because we already received it. So now we are down to 582,141. So now brand integration, let's see where we are there. Hold on, let's move this. Sorry, I should be going like this so you can follow me. We have 650,000 in brand integration, so let's put that in here. Goodbye. And then there is a fee due of 25%. So it leaves us with a subtotal. I should probably write it down here. Subtotal of 487, of which we will be getting 50% at the moment we are closing our movie, and then the other 50% will come later. So right now we get 243,750,000 because the brand integration company, advertising agency, will release only 50% on closing and will release the other 50% when the movie is finished. Our production incentives are 35% of the applicable expenses, which in our case is only the below the line. And then we pay a 10% fee to the lender upfront as well as a legal fee. So let's look at that. The below the line that we had was 8,695,000. Of that, we get 35%, which is 3,043,250. We're paying a 10% fee. And where's the legal fee here? Legal fee is 15,000. I'm going to put that in here. There we go. So we're going to end up with a production incentive amount of 2,723,925. So I'm going to make that green. This is money that we just got. In-kind services we worked on earlier. We're not going to get that because this is just a reduction. So I'm going to mark that gray, so you know you're not going to add that to your funding here because you're not going to have that. So if I add all the monies together that I have, let me make sure that we have all this. I'm going to click on here and make sure that we have everything. We have a production incentive, we have a brand integration, we have a crowdfunding, we have our mezzanine, we have our bank loan, and we have our down payment. I'm actually going to make this also green. So it looks nice, everything is the same. So there we go. Easier to find things that way. So we're getting a subtotal of $13 million. However, we need to figure out what equity do we need, and the way we figure this out is we're going to take our incentive, our strike price, and we are deducting from the strike price our subtotal, which is 13 million, which leaves us then with another 2 million that we need to finance, and therefore we have to finance 2,325,054 from our equity investor, which translates to 14.48%. So here's our strike price, and when you add those two amounts together, look at that, you get to your strike price. So here's our funding schedule. Okay, so let's go up and look at a few things, especially the US. Now we're going to our recoupment schedule here. All right. So we had our international sales earlier established at 12,845,684. We received a down payment, so that leaves us with 11,793,943 in international revenue. So I'm gonna make this green. This is for international. Let's look at domestic. Okay, the domestic box office. I'm not going to write domestic box office. I'm going to look up what that was. Let's go back there. US, US, US. Where are we? Here we go. US. Where's my box office? I know I had box office here somewhere. Uno momento. Financial elements, completion warrant. I know I had box office somewhere. Let me look. Maybe it's coming later. Ah, here we go. Box office, $20 million. So let's put that in here. Box office means the revenues that you received from ticket sales. In this case, it's $20 million. The exhibitor is going to get, meaning the theater owner is going to get 45% of that. So this has to be deducted. So the subtotal that's available at this point is 65%, which is $11 million. So now we're looking at how much money do we have to pay back to the P&A investor. And the P&A investor is giving us $1,500 per screen, and we have 1,500 screens. So the P&A investment amount would be 1,500 times 1,500. There we go. The interest, I should write that in here. The interest or premium, in this case, it's actually a premium payment for this is 12.5%. So we need to add that as a cost. So our entire P&A cost, I'm going to write down subtotal P&A cost, so you know what that is, that we have to pay back to the investor is $8,468,750. We also have to pay Paramount a distribution fee. I'm going to write down here Paramount distribution fee, so you know what that is. Distribution fee, here we go. So they're charging us 25% of what we are receiving, which is $11 million. So that goes here. And then the US revenues is basically whatever is left, which is we're taking our subtotal. Hold on a second, actually that's the deducted. Oh, hold on, that's already the subtotal, not for the P&A cost, but after the P&A cost. After P&A cost have been paid. So that's our subtotal. I'm going to make it in parentheses like this. So there we go. So the subtotal is the subtotal for the US revenues, and this is it. So now we have to deduct the distribution fee of 25%, and then our US revenues that are left are this, 5,718,750. So now we're taking both the US and the international rights together, which gets us 17,512,693. And I'm going to make this a little like this, so we know that these are the two revenue sources. Again, this is for international sales, which we had earlier, 80% of the budget. This is for the US. We started off with $20 million in box office. Of that, we have to pay the theater owner 45% of the ticket sales, leaving us with 11 million. We then have to pay our P&A investor 2,250,000 plus a P&A fee. So now we're left with 8,486,750. We have to also pay the Paramount Studio distribution fee of 25% of our share, which is 11 million. leaving us with $5,718,750,000 in revenues from the US. So altogether, we have distribution revenues of $17,512,693. The branding is now coming back. The second part here is paid, and now our total revenues are $17,756,443.62. And now let's look at all our expenses. We have to pay, obviously, our collection agent 1% of whatever hits the collection account, which in this case is the $17,756,443 number. Looking if there was a setup fee, let me check if in our assumption we had a setup fee or not. Sometimes the collection agent will charge you a little fee to set up the account. And in this case, it is also the case. So the setup fee per the assumptions was $40,000. So I'm going to put that in here. This is where we are. So altogether, we have to pay now 177 plus the 40. The bank loan is obviously our gross bank loan, which we established earlier was $7,333,279.85. The guilds, I'm looking at if we have to pay anything in guild residuals. Let me see. Here, $850,000. So I'm going to put that in here. Okay, it's 850. So there we go. The sales agent gets 16% on unsold rights, and then the 6% that was still owed from the pre-sales. Correct? Here we go. So we're paying 6% and we're paying 16%. So now mezzanine is being paid back here. Obviously, we have to pay a premium to the mezzanine. Then the mezzanine lender, I believe, also wanted a producer fee paid. So we're going to put that in here so that we're paying the producer fee now. So that should take care of that. And then we're putting in our equity. And of course, we're putting in our 20% premium. And now the in-kind services were deferred partially. So we have to pay a premium on that. 440,000 were deferred. So our premium is set at 10% for this. And now a profit, well, I should say it's not really profit, it's net revenues. I'm going to actually change that word because net revenues is what that is, which is gross revenues minus expenses. Always remember that. I'm going to make that cursive as a little note for you. There we go. So we are now receiving net revenues of $1,936,400 because we deducted all the revenues minus the expenses. And now we're looking at all the profit participation. Let me see what we have here. I believe the list is this. Talent, 30%. The equity demanded 40%, so we give it to them. Crowdfunding was 1%. And the mezzanine lender wanted 5%. So altogether, we're paying 76%, leaving us with $464,736.20. So I hope this summary helped you with your understanding of the final prep case study. So you can use the same template for the final when you do the question that you have in the final, and the template is here. You can download this template and it will be this. So it's going to be a little easier for you to follow the steps. If you have any questions about this final prep case study, please email me and I'm happy to answer your question. And if you feel I went too fast and you want me to explain it to you again, case by case, step by step, I'm happy to do that too. Okay. So I'm stopping the recording now. And again, if you have questions, you know where to find me.